Larry Sullivan with Chesterfield Faring Ltd. We're one of the sponsors here. I'm the CEO of the firm. We formed in 2006, and we're one of the largest players of distressed real estate debt in the U.S. We did about $8 billion of CMBS recapping back in the last cycle. We're getting a whole volume of deal flow over the last 3 months as rates rise. We expect next year to be a boomer year, probably the best year we've ever had. So we're going to let each panelist introduce themselves, explain who they are, where they work, and what their fundamental business is and what their business practices are, and then we'll get into the panel.
Tony Feynman. I am the co-head of originations for Acor Capital. We're a non-bank lender. We have about $20 billion of loans under management, assets under management. We do every part of the capital stack from we do whole loans, we do mezz, we do preferred equity, all asset classes throughout the country. That $20 billion is about 250 loans, and we have probably 110 employees in 5 offices throughout the country.
I'm Clark Hitch. I'm a managing director at Blackstone, part of the team that works across our various real estate debt investment vehicles, of which we have a handful. And among other things, I oversee our multifamily investments across the debt platform.
My name is John Lippman. I work at New York Life Real Estate Investors. We manage approximately $70 billion of real estate investments, including $40 billion of commercial mortgage loans. I run the structured debt team, which does our construction and bridge financing, and I also run capital markets for our equity team, arranging financing. And I'm also the portfolio manager for our structured debt fund.
A lot of jobs.
A lot of jobs. I should get paid for each of them.
You need to hire some more people.
Cheap bottle washer, too.
So,
Good morning. I'm Paul Fine. I'm a managing director at KKR in the real estate group. We manage about $60 billion of real estate AUM. I help to lead our investment strategy for our real estate credit vehicles. We have a little over $30 billion of AUM in real estate credit. We invest across multiple vehicles and products. So we have insurance capital, we have public mortgage REIT, we have debt funds. We do direct lending and securities that all sort of rolls up in that AUM. We have about a $32 billion loan portfolio today. And just to give a sense for kind of our activity in the market, we did a little over $14 billion of originations on the direct lending side last year. So similar to Lawrence, I'm hoping we'll have the best year ever next year, but we'll talk through the market and see where that leads.
Hi, I'm Steve Stewart. I run the commercial real estate lending business at Fortress. I don't know exactly what we have in terms of loans that we manage, but we've got about $60 billion of AUM. We also own a servicer, CW Capital, and we make senior loans, mezzanine loans, preferred equity, and we've also got an equity fund as well.
So the title of our panel today is Understanding the Shifting Lending Landscape, which is like quicksand and a volcano erupting at the same time. Obviously, all strategies that were on a year ago are different today. And I'm going to ask one question, let each guy answer, which is probably the most interesting to the crowd, is how are they attacking the new environment we're in today? So we'll start with our friend from Acor.
Well, I first of all, I think the new environment is in a constant state of flux or volatility today. So there is, I guess the first thing to say is there's been a tremendous reduction in the amount of activity that we're seeing and the amount of loan inquiry we're seeing, et cetera. And then we have just, I mean, I don't want to say we weren't selective and cautious before, but we've become tremendously more selective and cautious today. And deals just there's more and more deals that don't work, and I think we're just really at the beginning stages of some pretty significant economic distress in the marketplace, and so it's a little bit hard to pinpoint values, a little bit hard to pinpoint where you should be lending and what basis, and frankly, where we would be willing to do deals, the market's not necessarily willing to take those deals. Not to say that there aren't deals happening, because there are. We just the volume and the velocity is down significantly today.
I would agree with all that. I think what I'd add is, I think we, like everyone in the market, are focusing increasingly on the pressure that rising rates, especially in this moment paired with rising spreads, puts on deals. Existing deals that we and I think everyone have in the portfolio, and then also prospective new deals, and that has become a higher focal point. And like Tony said, I think that based on that, where deals pencil today from a leverage and pricing perspective, particularly for strategies that rely on some form of back leverage from a bank or other similar commercial institution, mean that the coupon that borrowers have to pay is much, much higher than it has been in the very recent past. And a bunch of deals aren't happening that would have penciled easily last year because of those combination of factors, which has just led to a decline in transaction volume, at least at the moment, as people sort of work through where they and everyone thinks we are and what the path forward is.
Yeah, we're sort of looking at the narrowing bid-ask as people digest the current interest rate environment, and hoping that will come together and spur more transaction volume next year. But right now we're being relatively cautious because we don't know exactly where that consensus is going to build, and I don't think anybody does, in terms of debt capacity and what real debt capacity means in the higher interest rate environment and what's sustainable going forward. But we're trying to size our new loans to what we think are going to be achievable takeout financings, especially on the bridge and construction platform, and that means lower leverage, lower advance rates, and tighter structure as we continue to make capital available, but we just do it in a way that's prudent in this more volatile environment.
Yeah, I mean, I think similarly in times of uncertainty, which we're certainly in, making sure the house is in good order and understanding what you own is sort of first order of business. So, we spend a lot of time, and we do this regularly in good times and bad, re-underwriting our book and constantly evolving our valuations and our marks and understanding, looking around corners where issues might, rise, and that helps inform what your go-forward investment strategy is going to be as well. And I think the better you feel about what you own, the more conviction you have in potentially going to play offense at the appropriate time with the appropriate cadence. I would say that we are, across all of our strategies, still in the markets in doing new deals, similar to the folks up here. We are certainly being more cautious. But look, I think volatility creates a lot of opportunity, and I would say the opportunity set to be a lender right now is quite broad. You're getting paid really, really high interest rates. We're going down in leverage and where we're lending. Structure is back, so we're being able to do much more prudent capital structures. And some of the activity and the demand on our side is a function of the capital base where we lend. And as Clark mentioned, is it a levered vehicle or an unlevered vehicle, and how does that influence, the various considerations that we have to go through in our underwriting. So we are playing, I would say, to kind of our core themes, which is playing in multifamily and industrial, the most liquid asset types, where we're still seeing top line growth in a lot of these markets that's outpacing inflation. But it's become a lot more nuanced. I don't think there's a wholesale strategy where we say we like this sector broad-based, we like this market broad-based. It's sponsor-specific, it's asset-specific, it's market-specific. And we're trying to find the assets that will participate in inflation in this environment versus the ones that will get left behind, where I think a lot of the pain can be felt. We've been more active as of recent in our insurance company. That is unlevered capital, so that gives us a little bit more flexibility to be able to navigate the markets. Whereas in our levered vehicles, our mortgage REIT, our debt funds and whatnot, we rely on back leverage to be able to create our levered yields there, and that's become a little bit trickier with the retreating of banks and insurance companies and some of the more conventional liquid financing sources. But pacing certainly down. I think we're in sort of this walk, don't run part of the market. But we do think the opportunity set's going to get more and more interesting. So we're sort of constantly evolving that dial. And I think the only way to do that is by being active in the market to know the right time to enter. But timing's important.
Yeah, I mean, probably not a lot to add to what everyone has said here. I mean, we're being cautious.
Just say I'm doing a lot of deals and everything's great.
Yeah.
These guys are idiots.
Yeah. Yeah.
Just give them your phone number and let them call you.
Yeah. I mean, same thing that everyone else has said. Deal volume is off. Obviously, a lot of things that were in process don't pencil anymore. Financing spreads have gapped out. Rates are going up, and the Fed is going to continue to push rates. I mean, the unemployment rate's still at 3.5%. So there's going to be a lot more pain coming, and we're going to be cautious and take advantage of the blood that's going to be in the street.
So, as a friend of mine this morning who was a speaker, he usually says, when everybody else goes right, I go left, which is Sam Zell. And actually, when everybody goes right, I go into a whole nother universe. So when everybody is going right, I'm always looking for what they don't want. So I'm always going after opportunities that no one else sees. And so I'd like to start with our friend from Acor again on what opportunities that other people aren't seeing that you're seeing that you can exploit this new market.
Out of fairness, should we reverse the order so Steve doesn't go fifth every time?
Fairness
You can
to
give your
me.
phone number first.
You didn't want to go second, is what was going on.
Yeah, look, we're doing some interesting things. For example, in office, I know that's not an asset class that a lot of people are financing, but we're not throwing the baby out with the bathwater. So if it's a good sponsor, it's a good asset. We will take a look at financing it. We've also looked at, speaking of office, several deals in the conversion office to multifamily, which we think is interesting. There's been a lot of folks that have done that successfully, and that's probably something that's just not mainstream.
Yeah, I'd say we're not very contrarian investors, so we're playing behind similarly what we've done the last handful of years. The long-term secular trends that we like. We do leverage the firm that we're part of, and try and create differentiated views and invest behind themes where the firm might have conviction that the rest of the market might not see. But by and large, we're playing again behind the themes that we think are going to be the best performers over the long-term horizon. So that's multifamily, that's industrial, that's life sciences. That's been about 80% of our originations to date this year. We are lower on office on a relative basis. We're probably about 20-some% office, and most of that is, in the Class A segment. We have less than 5% hotel and retail. So we're playing a little bit more, I'd say, down the fairway, particularly now in this environment.
Yeah, we're very focused on multifamily and industrial. The sector concerns that everybody's been expressing, we share. The one place that we're playing where we don't see a lot of other players today is in construction finance. For institutionally backed deals that have the inertia that keep on going, where we can go up in sponsorship and we can make liquidity available with all of the prudent structuring that we like at spreads that we love, at a basis that is really attractive. We view that as a great sector and a great space to play in now with the banks on the sidelines. We have a fully built out infrastructure for that, and now is the time to make hay, where there isn't a fundamental problem in the underlying real estate, but a regulatory-driven pullback by the banks.
Now that I'm fourth, my turn to borrow from my previous panelists. We're doing, I'd say, a mix of things, just given the breadth of our capital base and vehicles and what the right sort of risk-adjusted return is across those different profiles. To Steve's point, we are still, cautious on office at a macro level, but seeing some opportunities within that as some participants in the market take a little bit more of a binary approach there. To Paul's point on thematic, we are generally an extremely thematic investor, and have some very large themes where we've been very active over time. And industrial and multifamily, those aren't contrarian views. Where we're maybe a little bit differentiated there is that we, like other groups, focus a ton on using the real-time information coming off our existing portfolio, and sometimes are willing to push a little bit further in those, sort of leaning into those spaces that everyone generally agrees the macro fundamentals are good for. Given that we think things aren't just good from a fundamentals perspective, but maybe better than others perceive right now. And then similarly to John's point on construction, we are selectively doing construction. We've historically done a handful of construction deals a year, always with sort of a particular focus on scale, sponsorship, wherewithal. But right now, think that there's an opportunity, as banks are usually one of the most active participants in the construction market, pull back to finance some large-scale, sort of best-in-class projects for extremely strong sponsors that we feel really good about, sort of the long-term durability and demand for.
So I would say that I agree with Paul, or I would say that similar to Paul, we're not really a contrarian investor, but I also think that it's a little bit of a misnomer to think that there's a lot of contrarian bets that you can actually make in the business that we're in, frankly. But, I think our investing is very acute. We're going to invest to particular borrowers on particular assets in particular markets, and not to the guy next door, frankly. I mean, that maybe, is how we look at it. But at the end of the day, Sam Zell said something before. He said, this is not a simple business, it's a complex business. And I know what he was referring to, but it also is a simple business. So, 9 months ago, the index was 10 basis points, and spreads on, value add multifamily were 250 to 300 over, right? We were losing a lot to KKR at that level, but it was 250 to 300 over, right? And today, that same deal is 5 to 10 points tighter in leverage. The index is 350 wide of that, and spreads are anywhere from 75 to 150 wide of that, right? So it's a pretty simple business, right? I mean,
Or 250 wide of that.
yeah, exactly.
It depends who's
I'm
charging.
trying to be optimistic.
Mine might be 600.
But the point is that there's a value issue. We don't predict that interest rates are going to fall, and we bet today based on where interest rates are going to be, a year from now. That's not the game that we play. It frankly isn't the game that I don't think any of us play, right? We look at what's going on in the world today, and does it make sense? Yes, we look at future cash flows, and we don't think that the world ended, and we think that there's going to be opportunity, but it's all about basis at the end of the day. So, we made a couple months ago, we made a low in a B-ish quality office loan in Lower Manhattan. And, I didn't really want to talk about it in the press, but I got interviewed and I told them why we did it. And then everybody in the world was calling us because we're the big office lender on B quality office in Lower Manhattan, right? We're not. We were at, I don't remember exactly what the basis is, but let's just say we were under $100 a foot, and there was a ton of cash with a tremendous sponsor, which we've learning it does not always mean. That's not always a positive thing today, but it was who made this loan. So contrarian. No, we're. I think all of us will tell you that none of us, because I know all of us, we're not going to say we don't do any office, we don't do any retail. None of us are going to say that. We all have capital to put out, but it's just it really is a very acute analysis. At the end of the day, I think it's simple. It's getting to a basis that we feel tremendously comfortable with, and There are sponsors that you would think would never throw the keys at you that we're starting to hear will. So maybe we're a little bit more cautious than we were a year ago in that regard with that part of the analysis. But at the end of the day, it's about basis. So
I appreciate everybody's input. I'm glad to see we have a lot of traditionalists here and non-contrarians. I know where to go now for traditional deals. Sorry about that.
we're lenders, by the way, right? You're on a lender panel, so we actually don't we don't make
You
a lot
don't
of money
take risks by their nature. No,
we don't make a lot of money for making gigantic bets.
No,
right?
of course not.
Contrarian bets.
which of course I do.
Just
So
lose.
yeah, I'm still the perfect guy to moderate this since I don't compete in any way with you guys.
Well, we like to buy distressed notes too. So
Oh, well, then
question.
we'll
I mean,
talk.
but
'Cause that's all I buy.
That's
At
we can talk about that, 'cause
35%
that's
loan to
definitely-
value at
we're starting to see
21%.
that as well. So.
Yeah, we like 35% loan to value at 21% default rates. And then we lever it with 100% financing at 10 and, make the spread income. So we're glad to take note on that financing from you guys and have us both make very high yields. So the next question is one you guys probably wouldn't have expected, but no matter how we look at it, the U.S. is not isolated. We're in a global capital markets. And with rising rates, while all the rest of the world is already in recession and their rates are still flat and low, and now the euro is at parity, the pound is at parity with dollar, which we've never seen at least with the pound, in probably 50 years since after World War II. And with the euro, not since like 1996. So now no Europeans see that buying in the U.S. is a good deal if their currency is low. Their interest rates are low, though. So is there any way you guys see, maybe we start in the middle this time with our friend from New York Life, is there any way you can access that cheap debt, but at the same time use the strength of the U.S. currency? Do you see any way to do that?
We're seeing, foreign investors be very concerned about the cost of hedging back into their dollars or their currencies. So when you have a strong dollar, it's difficult for that foreign capital that has to look at what their return basis is to their liabilities. So if they're denominated in whatever foreign currency, they have to think about round tripping that and how that impacts their own liabilities. So, ironically, the strong dollar has made it, in many cases, more difficult for foreign investors to invest in the U.S. Taking your question in the reverse, which is, life is a pop quiz, because I don't know I was going to,
Well, should you go ahead and invest in those markets?
The reality is that if you could take a U.S. dollar funded opportunity that had excess returns enough to support that carry trade, that FX,
Right.
then yes, I think there's huge appetite from foreign investors to come into the U.S. market, but the cost is higher, and that's going to, by the way, increase required returns from newly minted debt funds, because the investors are going to want higher returns, just if for nothing else, to pay for that increased hedging cost. And that could have a sustained impact on junior financing spreads as we move forward. That's much less liquid and reactive to the capital markets, where mortgages trade by and large as a spread to corporates. So that's much more liquid and reactive to what's going on in the States. The foreign investors' appetite and requirements for debt funds will have higher returns on the junior capital, I think, for some period of time.
Which is going to have a further impact on what we're talking about on valuations today, right? I mean, the last couple panel or whatever, the last panel talked about a lot about all this capital that's sitting on the sideline. The problem is the capital that's sitting on the sideline wants tremendous yields today.
Yeah,
It's
but they're
not
earning
replacing-
nothing when it sits on the
It's not-
sideline.
But it's not replacing the illiquid part of the market that is causing, that is causing the lack of activity. So
Why don't we do our friend from?
I agree with John.
Okay.
He actually answered that incredibly well. But no, look, I think what you are seeing, this doesn't answer your question directly, but the bank markets are very different in different parts of the world. And I think part of the question is, particularly around this whole inflation conversation, is how much of this is a global thing, how much of this is a domestic thing in different parts of the world. I mean, you look at the U.S. and we all see, kind of the U.S. money center banks, they're not in the market at all. If you go over to Europe, the banking activity is better there. And, Blackstone has a big business there. We just set up a lending operation there. It's not a much more, but it's a more liquid market than what you're experiencing here today, even though they're further along in the recession story. And then you go over to Asia, and that's a completely different story, right? The Asian banks have, a lot of appetite, but again, a lot of this is staying domestically. It's not exporting it to the US.
I would just add to that like the liquidity in the European banking sector, is maybe a lot greater than it is here. And that's just because it historically has been that way. They don't really have a capital markets as developed as we do. So, the amount of financing that gets routed through the capital markets here in the U.S. is, vastly greater as a percentage than it is in Europe.
But also because of the European covered bond market, which helps to maintain that liquidity as one of the oldest forms of real estate financing for the local European banks. That's a tremendously sustainable capital source. And realize that, again, the reason for the pullback in domestic money center banks and regional banks at this point is regulatory driven. It's not fundamental driven. So the fact that the ECB has not similarly ratcheted down has left that window open in a way that just doesn't exist in the U.S.
I'm glad I asked the question regardless. Okay, so I guess the next question, then we're going to leave it open for questions for the group, so you can ask individual people their opinion on things that we haven't covered, is where do you think the next year goes? Why don't we start with you?
Well, look, I think next year is going to be pretty bad in terms of liquidity in the market. You're going to have, as I mentioned, the Fed's going to keep bumping rates. We're going to be, if we're not already in a recession, in a recession. So, you're going to have a lot of headwinds that you're fighting. Illiquidity, recession, high rates, and there's going to be a lot more distressed opportunities, which we're excited about.
What food groups do you see? Which food groups do you see are the most likely that'll create the most opportunity in the next 12 months.
Well, I can't remember which panelist said it, but the stuff that is not able to pass through the inflationary pricing in the asset class is going to get crushed the most. So we do have a housing shortage. So multifamily, you're still going to see rent growth. It's not going to be as high as it has been in the last few years. Industrial, there's still a lot of demand. I don't know how much more of it can be built and have that rent passed on to the end user. But those are two pretty defensible asset classes in real estate. And then you've got obviously when you have a recession, hospitality is going to get hit probably hardest and first. And anything that's got a really conservative capital structure, should be able to weather the storm. And every time there's a cycle, the stuff that gets crushed the most is the stuff that is over-levered.
Yeah, I agree with that. I mean, I think 2023 is going to be a pretty nasty year. I think in terms of inflation, I think you'll start to see that moderate a bit, but I think the view is that that'll still remain high. It's not going to be an 8% year, but maybe it's a 4.5%, 5% year, and that's still well in excess of the Fed target of getting normalized back down to 2%. I think you'll see as a result of that, interest rates, the resting heart rate remain high there. You could see the Fed funds rate being high 4s into the 5s going into next year, and I don't think you're really going to start to see much moderation, assuming that these strategies are successful on the tightening front, really into 2024. So I think this will be a year or 2023 will be a year of volatility. I think you're already starting to see a lot of activity on the distress side. People are starting to clear balance sheet. Banks in particular are looking to shrink balance sheets. So you're going to see paper hit, and there's a finite number of buyers, right? So some of this is going to be who gets to market first, when does capital get invested? Somebody made the point that there is a lot of dry powder on the sides and a lot of money that was raised to go invest in distressed notes and distressed real estate, but those people want to earn, and there is going to have to be some capitulation on the bid ask on some of this stuff to be able to clear, and people have different motivations as to why and where they would sell, paper. So I think you'll see a lot of that going into this year. And then you go back into what gets hit the most. I mean, I think we've probably seen on multifamily valuations come down 10 to 15%, and that's probably sort of the best case. And then you go to where things most illiquid, and that's going to be the stuff where there's not as deep of a bid. So look at office. That's going to be things that have longer dated leases that can't participate in inflation. So you do get the benefit in things like housing where you can mark your rents to market on a more regular basis. So we still like the things where the supply demand fundamentals will hold up in this type of environment, which goes back to housing themes. That's conventional multifamily, student, senior housing, age restricted, et cetera. Industrial, the fundamentals still quite strong, but I think there's going to be other assets that sort of disproportionately get hurt, and I think that's where you'll see a lot of the pain. And then you do, rightfully or wrongfully, you're going to have a little bit of the baby with the bathwater in the office sector, in particularly. I think there's a lot of spook right there. I think a lot of people have taken the binary view. Again, that's probably not the right view on a wholesale basis, because there are going to be good assets and assets that perform well that people are going to buy cheap and probably make a lot of money on. But I think you'll see a lot of that paper start to trade in the coming quarters.
I think on office in particular, not to just reiterate, I think I agree with a lot of what you said, and I think Steve's concerns about hotels, hospitality demand, RevPAR and GDP are very, very correlated. So I think that's not surprising that as we enter a recession, that I think over the last 12 months, starting the summer of 2021, there was a renewed bid for hospitality coming out of COVID. I think that's now waned from many lenders just because of that correlation I was talking about. Broadly speaking, multifamily and industrial are interesting, but office, I think one of the ways that people are throwing the baby out with the bathwater is that when they talk about what's going to drive office and what are the amenities that tenants are looking for, and how are those defined? Are those defined by building the kind of floor that we're on today with a coffee bar and a couple of keg taps and so forth? Or are people focused on shorter
More time to drink in the office. So
who doesn't want to get drunk with their boss? It's always good.
Good that they have
So I think when we talk about amenity or what could go wrong, When we talk about amenities, we're talking about, proximity to transportation. We're talking about the real fundamentals, easy access, clean air, good light, what's intrinsic in the building that tenants and especially younger users, you can talk to office tenants, they're talking about not what does the partner benefit from, but what does the franchise benefit from of training junior staff and being in the office together, and what are those tenants looking for? Is it a ping pong table and a beer tap, or do they want to do that without their boss around? In the office, are looking for good parking and safe egress and that kind of stuff. And that, I think, is going to drive a lot of different opportunities in office. So evaluating changing amenities is really important to us looking forward into opportunities.
We've also been in an environment where people have had a lot of choice given, how tight the employment market has been. If you go into a recession, if that changes, if, the unemployment rate ticks up, people start to lose their jobs, I think that dynamic could shift a little bit. And all of a sudden you're going to have the, do you want to work hybrid to you have to come back to the office? And I think office got crushed by a lot of things, right? Like you have had the haves and have-nots, and I think there is liquidity and there is a financing bid and there is tenant demand for the high quality stuff for sure. But you've had the hit of you've lost demand overnight. A lot of these buildings have become functionally obsolescent overnight, and all the investor liquidity has evaporated overnight. So it's kind of been the 1, 2, 3 punch there. I think if you get the tenant demand back, that obviously helps fuel and drive some of the other stuff.
Go ahead.
In an attempt to be additive, I would say I think as we think about the year ahead, we would all admit like that there are risks, but there's also uncertainty. I think if we had had this panel a year ago and been asked about the year ahead, none of us would have gotten it exactly right. But as we think about the year ahead,
I would have, for sure.
Yeah. Well, sorry. Other than Tony,
I knew this was going to happen.
That's because he gets great tips from his hairdresser.
Seems like Tony's paying for lunch then.
The only guy with less hair than me on the panel.
I think that given the volume and nature of the financing activity that happened over the last sort of 12 to 18 months, they're going to be as we think about what in our world is going to happen in the year ahead, there's going to be less activity for a bunch of the reasons we talked about, including the impact of cost of debt on whether transactions pencil, but also largely driven by the fact that a lot of people are going to say, my current loan today is better than the new loan I could get in the market, and that will tamp down demand for new activity, especially if it's paired with a period unlike some of the really significant value creation of the last 12 or 18 months again, where people could decide that they wanted to get a new loan, even if they're paying the same rate because of value appreciation that they were then able to tap into in the asset. So I think that, there's likely to be meaningfully less transaction volume in the near term, absent asset-specific and maturity-driven occurrences, speaking generally.
Go ahead, Tony. Why don't you add?
Well, I'll say I'm going to go back to the question being like, what does the next year look like? When opportunities? First of all of us, right, have to, like, as Paul mentioned earlier, we all have fairly sizable portfolios that we have to play defense on, right? I think most of us have fairly patient capital and good capital structures, and we're going to be able to work through this, right? But there's lenders that are not on this panel that are not in that situation, right? And if you talk to the loan sellers out there, this is the first time in many years where they're busier than they've ever been. Stuff's just starting to hit the market today. Their financing is not as patient. I mean, those lenders that are looking to trade out of their loans, their financing is not, but they have to create liquidity or they're going under, frankly. And they're going to take losses as a result. And we're going to, that's one of the opportunities is going to be to buy this stuff. Again, we also have to, though, look at what basis we're buying these loans at and what the return is, and which is the other opportunity that you're kind of referring to. The bottom line is that, like I said before, it's not really that complicated. Interest rates are more than 2 times what they were 9 months ago. They are for every asset. And our appetite for returns is commensurately higher. And as a result, the opportunities are going to come from the movement of capital again. What I mean by that is that I feel like we're grinding to a little bit of a halt right now. I mean, I think things have gotten slower and slower and slower, and this is what usually happens. It's not always the same situation that causes it, but there's fewer transactions. But at some point, transactions actually have to happen, right? Wells Fargo has a $55 million loan on a $100 million asset. It's now, or they thought was a $100 million asset. It's now a $70 million asset because that's what the market is now telling it. Wells Fargo doesn't want a $55 million loan. There's not a $55 million loan to replace it at the same leverage level. So Wells Fargo is going to say, now it's a $40 million loan if you want to keep it. And the borrower is either going to have to come up with that $15 million or we're going to come up with that $15 million. That's where the opportunity is going to come. But we're only going to come up with that $15 million if we actually think it's a $70 million asset and don't think it's a $55 million asset, right?
And we get paid well for doing it.
And we get paid for it, right? So that to me is that's what we all believe is the opportunity. Frankly, it's not that complicated. I know you're saying to be a contrarian, but a contrarian is going to go out and buy a bunch of B quality mid-block office that has no tenants in it. That's what a contrarian's going to do. No, what I'm saying is
No, we buy the underlying debt on it.
Yeah, but we all buy the underlying debt on it, frankly, and we all are going to leverage it the same way you're talking about. The bottom line is that there's everybody talks about. I'm going to say this again. Everybody talks about all the capital that's sitting on the sideline. It's been sitting on the sideline for a really, really long time, right? Because this, as Sam Zell said, the crisis that we're in right now is actually it started in 2007, 2008. And the can has been kicked all the way till now. We had a pandemic in the middle of it. It created a little bit of a detour, but it's kicked the can. The can is now broken. The road's done. There's no place for it to go anymore. And now is where the opportunity is coming. And
right. I'd like to add one thing to all the panelists is, from my experience doing distress now since the 80s, is you actually see certain asset classes become the hardest to finance. And the first is development and land loans, and then you start seeing hospitality loans. Then you start to see, different types of hospitality loans get harder to get done. And then you start to see certain types of office getting hard to get done, like B. And then it goes up the food chain till you finally get to triple net industrial, where you're only looking at corporate credit, which in a depressed time is the least amount of risk. So that hierarchy is very important to look at as you put out new loans or buy old loans, is which types of properties recuperate the quickest. And obviously, the first food group that always seems to recoup the fastest is multifamily, especially in urban markets. That's what I've always found to be true. And then more of the suburban starts to recover. And so they're the last to go down and the first to recover. So you guys saying multifamily before makes a lot of sense, what to look forward to next year, not just making new loans, buying existing loans. One thing
I think there's going to be a lot of pressure on the multifamily market as well, because it's not going to be pressure because people are necessarily underwater the same way they might be underwater on an office bet. But if you were buying multifamily at a 3 cap and you were lending to multifamily at a 6 debt yield and then hoping for, in both instances, hoping for a decent amount of rent growth, at some point there's an affordability issue, right? The upside down leverage, negative leverage is it's wonderful that Sam said it's been around for a long time, but negative leverage is a problem, right? And it's a problem unless you think it's not, at some point equity is going to be needed to fix these problems. And so it's not the same thing as an office building it's not the same kind of distress, but I think there's some basis problems in multifamily.
No, I agree, but it's the least risky of all those food groups. But on the multifamily side, to get a little bit more closer to the skin. So let's say you recap a deal, it's $100 million, and now it's worth $80 million because of cap rates. And originally you only borrowed 60%, it's at $60 million, and you're going to put in a new dequity piece. I don't call it equity because you're only going to do it if you're doing his pref or a mezz for another $10 million to give the guy some working capital because his rents are actually flat or declining because he hit the affordability index. So now all of a sudden the guy has to give up a lot of equity where he says, maybe I should just wait out the cycle. So you have what we had the last time, like Sam said this morning, extend and pretend. You're going to see a lot of that, even with the lenders, because one thing I always explain to lenders when I'm on the other side doing a restructure is a defaulted loan versus a modified loan is worth a lot less money. So it makes a lot more sense to extend and pretend or modify that loan than it is to put it in default and then make that a fire sale. I always come up with three values. I come up with the retail value, the wholesale value, and the fire sale value. And the fire sale value is always 30% lower than the retail value.
I think. Sorry. You go first.
Go ahead.
I was just going to say, when we talk about recapitalizations, we talk about opportunities. One great area to think about next year and talk about multifamily is to think about the tax consequences for the over-levered buyer or owner of multifamily assets that have refinanced and refinanced and refinanced out. That borrower that's owned the asset forever and has no equity in the deal and does not want to have cancellation of indebtedness income and doesn't want to begin a tax process and that's going to be very painful is really motivated to work with capital providers that don't just kick the can down the road, but that mark the asset appropriately. And it may mean giving up a fair amount of the economics in the deal, but they do have a hope note and they do have an option in the future. They do have some call option available for when the NOI grows to a certain point. And it's not crazy for those people or those entities to just be realistic about the capital that's available and capitulate to live to fight another day. So if they're talking to groups like any of us on the platform, right, about how to recap and say, yeah, you know what, I might not see any cash flow in the near term, but I will live to fight another day, and 5 years from now, that I may be back in the money, and oh, by the way, I avoid a substantial tax bill today. It's not crazy. And that doesn't necessarily mean that the senior lender is going to take a hit. That just means that the risk lies where it should, at the equity.
I'm sorry, but I'm going to cut this part of the conversation over because I have...
I dropped the mic.
So there's one last conversation I want to have with everybody and see what your thoughts are. As in 1991, I was involved in the first CMBS deal with DLJ. And what motivated the first CMBS deal is there was no capital out there to make loans. And we're in another environment similar to that, 30 years later. And I actually believe there's a new technology here. And I want to introduce Ryan Ziga right there. And he's in this new type of technology that I think is going to be very interesting in the next decade, which is tokenization of debt and equity so that retail investors can invest in what you guys invest in. And I'd love to get your thoughts on what you do know about the industry. And you should all talk to Ryan after the conference to see what they're up to, because it's a very interesting technology.
Hopefully we run out of time before you get to me.
Well, I thought I worked on
me
the first,
too.
I thought I worked on the first CMBS deal at 87 Meritor Financial.
Oh, really?
Yeah. So
was the first one, 91 with the Ginsburg.
yeah, no, we did when I was at Goldman, we did a transaction for Meritor. So that was yeah.
Oh, I didn't see that one.
Anyway, I think
Okay.
tokenization of assets, it's something that's going to happen. It's already happening. You're seeing platforms like CrowdStreet, crowdfunding. So it's definitely going to evolve. It's going to grow, and it'll be a bigger part of the equity universe of owning real estate.
I know next to nothing about tokenization or Bitcoin or crypto or any of this stuff, so I'm not going to speak about that. I do think what we've seen in our business, and Clark should speak to this because they're one of the bigger players, but the democratized vehicles applying into the private wealth channels is the flavor of the day, particularly in private equity. It's a great way to give access to the retail investors to institutional product, and it's a great fundraising apparatus for the large money managers, in addition to what you're otherwise doing in raising your more conventional funds. So I think that is viewed as a huge growth engine in whatever way you do it, whether that's through private wealth platforms, whether that's through tokenization, and whatever all of that means. But that is a big part of our sort of go forward fundraising thesis, and something that we're actively doing in the market today.
I agree, and I think that that is the right way to expand the investor base. I just caution investors in those kind of vehicles that it's not a great mark-to-market play. It's something you should, if you trust your manager, you trust your asset manager, make an investment, make it part of your portfolio that's not correlated with the rest of your portfolio, and leave it there. Because if you get, if you're the kind of trader who wants to be in and out, this is not a great asset class.
Agreed. I mean, retail investors are pretty materially underallocated to alternatives relative to institutionals, is I think pretty broadly known. And so whether it's tokenization or more retail-friendly investor channels that exist today and are represented by some of the firms on the platform, I think there'll be increased activity in that, and that, as John said, if it's done with a long-term view, it can be a super additive part of people's portfolios.
I'm not adding this conversation.
We're out of time anyway.
Oh, we are. Oh, do we have time for just one question from someone? Roger? No?
Quick, 30 seconds.
Okay, anyone have a question? Go ahead.
Are you seeing development deals in either multifamily or industrial, which are very active now? Are you seeing those deals getting filled because of lack of financing? And obviously that's the last 90 days or so. Or are you seeing those deals that started talking through this summer?
They're jumping out of the water in terms of what's coming across the transom to finance. I think people have to be very selective about which deals they're going to pursue. But if you have a bid for it, there's a lot of deals that make money.
Yeah, and the answer is yes. We're seeing a lot of those deals, and a lot of them are not getting done. It's true. I mean, there are deals that are getting done. I mean, but they're just not as many that we're getting as before, because the numbers don't always make sense. Frankly, the asks are not always the asks are not commensurate with what the capital is willing to provide. So
Yeah.
The credit checks out. It's a relative value game, right? If you can go do the existing cash flow and multifamily deal, you got to get paid disproportionately more to go write the construction loan. The only thing that's interesting is a lot of that in the leverage loan business, that you can now get yield on leverage deals that are starting to creep up to double digits, which is kind of interesting for different pools of capital.
What you don't get is outstandings necessarily, and so it comes with increased yield protection for the lenders who have to make sure that there's return on effort that's also commensurate in terms of a minimum multiple, not only an IRR.
And a lot of the deals are just getting done at lower leverage because of the pressure the cost of debt puts on the system, and people decide they are going to borrow 60 instead of 65 or 70 because it gets to a different capital provider, but there's less liquidity right now.
So if all the panelists agree to stay for lunch, feel free to inundate any one of them and ask more questions, since we're out of time. Thank you.